The financial documents is what we're going to talk about next. So what are we going to do today? Well, I want to talk about the key financial statements that you should have for your business and also that you have in your business plan. And I want you to understand what those statements mean and why they're important. And I mentioned before that you should be your own chief financial officer. So you need to create a checklist of what kind of financial records that you need. Do you have a budget for your farm and for each crop? Do you know what your key performance indicators are? Do you even know what that means? What are your goals for the year? We've talked about SMART goals already. Do you have a business plan? Hopefully you're starting on one today. What are your goals in the next 5 years? As you know, the world's changing so rapidly that probably further than 5 years is unrealistic to have, maybe 3 to 5 years, and then review that every year because things are always changing. Do I know what records I need to keep track of? And how do I compare to similar operations? And this is a tough one because, as Kenesha said, most of you are sole proprietorships. So that means that your records are not made public to anybody, whereas the C Corporation, you can go online and look up their records. So I think the best thing is to compare yourself to yourself each year and keep records so that you can monitor and look at your own performance indicators and see if you're meeting your own goals for your farm. And financial records are critical for management, planning, and monitoring to sustain the profitability of your business, because I know a lot of people, farming is more than a business. Let's face it, we do it because we love it, right? But if you're not making money at it, you're not going to keep doing the thing you love. So you need to make a profit. You need to look at historical records to see where you're going and evaluate past performance to look at the future. And it gives you information to understand your financial risk and make good decisions. We already mentioned Ag Plan. I can't emphasize this tool strongly enough. It was developed in the Midwest, so it's got a very Midwestern focus in terms of the examples. But there's 3 things that I like about it. One is that for every topic on the business plan, there's usually at least 4 fact sheets from various universities across the country that give you information on what that particular part of your business plan should include. You can type it up and then come back later and change it. And you can also pick your county agent or me or someone else as a reviewer. And if you pick us as a reviewer, we get an email and it says, go look at this plan, and we can make suggestions. So it could be your accountant or anybody. So I think that's useful. Another thing, we talked about advisors. I know that some farmers have a group of other farmers that they get together and share ideas and monitor each other. I've also heard farmers say that they have people that don't know anything about their business come to their farm, and it's kind of painful but also helpful because they go, well, why are you doing that? And you think, I don't really know why I'm doing that. And so it gives you some really insightful feedback to get you on the right track and help you have a better business. So these are the 4 key documents that we think you need for your farm business. These are key documents that you really need to get together basically for tax purposes anyway, but you need them for management purposes as well. One is the income statement that looks at your income, expenses, and then your net income or profit. Your balance sheet, which looks at your assets, everything you own, the liabilities, the part that you owe, and the net worth, the part that you own. The cash flow statement, that's useful for looking at sources and uses of cash. And then your enterprise budget, so you can tell which enterprises are profitable. If you have more than one enterprise, then you need to do some cost accounting so that you know which ones are making money and which ones aren't. So we'll talk about that briefly. So income statement is the business income, expenses, and net income. Balance sheet, assets and liability. It informs you about how a particular investment will impact your business. And a cash flow statement identifies the working capital needs and shows the impact of a new investment. And enterprise budgets, like we said, are telling you what's most profitable. This is the simplest form of an income statement. I think I can't walk around because I'll lose the the voice. So normally I would want to point, but this is about as simple as I can get an income statement. So the first line is your sales or your income. Then you have cost, and we divide cost into 2 categories, direct or you may have heard it referred to as variable cost, which are easily allocated to each crop or livestock operation, and then overhead costs that occur no matter what you're producing. So you subtract those from the sales, and then you get your profit or loss, and that's why we call it the bottom line, because it's the bottom line of your income statement. And another version of an income statement is your IRS form, Schedule F, if you're a sole proprietor and working as a farmer. It's basically your income statement. So we mentioned the two types of expenses, direct or variable. So the direct expenses are directly related to what you're producing. So if you're in a greenhouse and you're producing mums, the pot is a direct cost. So as you produce more mums, you spend more money on pots, but the cost per unit will stay the same unless you grow enough that you get a quantity discount. But in general, it's the same. Whereas overhead or fixed cost are any expenses that a business incurs regardless of production. So things like that. There's one example, we call it the dirty five: depreciation, interest, rent, insurance, and taxes. Other examples are your salary. I guess those are part of the dirty five there. Okay, so I'm giving you some greenhouses are what I know, and the numbers aren't so important, but just give you some idea of some categories. This was a survey we did of actual greenhouses in New Jersey and Pennsylvania. And what I would suggest that anybody do is not worry so much about the numbers, but look at percentage of sales and see if that changes over time. And like I said, I worked in greenhouses for a long time, and I've noticed even from 30 years ago, these percentages haven't moved a lot. So that's one way you can compare yourself year to year and yourself to other producers. So I mentioned the direct cost, and one reason I like to call them direct versus variable is because in the short run, everything is fixed. You've got to pay you've got to pay these things. You already have them. In the long run, everything is variable because you can always sell out. So I prefer to think of them as direct and overhead. Labor, you notice here the overhead salaries are only $2,800, and it's actually much more than that. But the reason is because everybody's a sole proprietorship. So what do? They pay themselves out of that bottom line, and they call that profit. So be careful when you use the term profit, because it often isn't really what we think of in an economic sense as true profit, because your salary should come out first, and you should get a return to your risk that you're taking as running the business. But general labor is a variable cost or a direct cost, and your overhead salaries would be an overhead cost. The utilities are actually sort of variable or direct, but it's hard to allocate them to each crop or operation that you have going on, so I use them as overhead here. And I'm also sort of following the KISS principle, keep it simple, stupid. So the ag engineers would give you these complicated formulas to allocate your heating cost to each crop. And if you want to do that, that's fine. But rather than doing nothing, I would suggest take it from your income statement, your Schedule F, and allocate it as an overhead cost when you get to cost accounting. So here's the total overhead we came up with is about 17%. So the net returns is 9.5%. But remember, there was almost no money in salary, so that isn't really the true profit. But it's actually, some people say that's not enough, but for an ag business, that's a pretty high number, 9.5% profit. So what does net profit margin means? It's the profit per dollar of sales after you pay your salary and you take into account the cost of actually using your land, because if you're sole proprietorship, guess what? Land doesn't depreciate, so you can't subtract for that either. So you might want to put in a cost if you could rent that land to somebody else, and your capital invested. If you thought that 9.5% profit margin was too low, what can you look at to try to make it better? Well, maybe you don't have the right pricing system. I think we've tended to, in agriculture, not increase our prices in the last few years. At the same time, our input costs are going up, and we're staying the same. So what's happening to our profit margin? It's getting squeezed. The cost may be too high relative to the size of farm. A lot of you are small farms, but sometimes you can't find small equipment, so you're investing in big equipment, and you don't have enough sales to spread that cost over the whole farm. You may have not enough sales for the resources, high overhead cost. You may spend too much on inputs. You need to shop around, and Hurricane Sandy may have caused some damage, or some other natural disaster where your production is a problem. If costs are too high, things to look at are what costs are the highest. That makes, if you're looking at something that's 30% versus 2%, you're going to have a lot bigger impact if you can control that 30% item. But can you control them? I've been working with greenhouses for 40 years now, and I always said labor's the highest cost. And when I first started saying that, people said, but we have to have labor, we can't control it. But guess what? People have figured out they can control it by training their employees so that they're more productive, so that they don't have turnover, so that they stay longer. We're going to automation. I was just at a greenhouse in Texas last month where they had 2 robots doing things that people used to do. So there are ways of controlling it. Can you do the same function in a better way? Thinking of something creative. What about mechanization? And again, I've seen a lot of potting machines sitting in the back of a greenhouse where people thought it was going to be a good investment, and it turned out not to be. So think through before you invest in these things. But mechanization can save you money if it's the right size and the right kind for your operation. Again, I said, can you be mechanized? A lot of farmers like all the engineering and the toys, and you can buy too many things. You need to think about, is this a business reason, or is this just a new toy that I want? And it's okay to buy the new toy if you have the money to do it, but make sure you understand that that's the reason. Can you use the labor more efficiently? Agriculture is a seasonal business, so you may keep your employees all year round, and that's in some ways wise, but then in the slack periods, what do you do? And I find more and more farmers in New Jersey being more diversified because of that reason. So greenhouses used to be just greenhouses in the spring and poinsettias in the fall, but now they're doing things in the summer to keep that labor in use, to keep the greenhouse in use. So the more you can spread those overhead costs over more enterprises, the more profitable probably all of your enterprises are going to be. And you may be scrambling for labor in the peak periods. So these are things to look about as far as cost. So remember we said that that typical greenhouse was showing a profit of 9.5%. So what if I could control $1 of cost? How much money would I keep in my pocket? Basically $1. But if I increase my sales for $1, how much do I get to keep? Roughly a dime, right? Because I've got roughly 10% profit. So cost control in that sense is more important than trying to increase your sales. You probably want to do both, but in a low profit margin business, cost control is key. We talked about balance sheets. So balance sheets show the assets, liabilities, and net worth. So it's just a simple equation. Assets are everything in the business. Liabilities are things that other people have claims on. And net worth is the part that you own of the business. It's just as simple as that. I find some people are really scared about balance sheets, and it sounds scary, but it's just, a simple math equation. Why is it called a balance sheet? Because it has to balance. Your assets have to equal the two components of who owns them. The liabilities owned by others and the net worth owned by you. Or you can flip it around and say net worth is the total assets minus the liabilities. So the net worth is the part that you get to keep. So here's a simple example of a balance sheet. The assets are on the left, the liabilities are on the right, and then the total, they have to balance. Assets have to equal liabilities plus stockholders' equity. We also segregate it into current and non-current. What does that mean? Well, current assets are things that are cash or will be turned into cash within 1 year. What does that mean besides cash? Well, inventory, accounts receivable, prepaid expenses are some examples of that. Non-current assets are for assets that were going to last longer than 1 year, like your vehicles, your equipment, your barns, your greenhouses, your land. So again, I made up a balance sheet to match that income statement that we came up with, and looking at current assets and long-term assets, so that adding those two together are your total assets. And then liabilities we treat the same way, current and non-current. So current liabilities are things that we have to pay within the next year, like notes payable, accounts payable, rent, taxes, and interest. Non-current liabilities are the long-term debt that we have because we have a lot of long-term assets. We match the life of the asset with the debt structure. So we have term loans on the buildings and the land, and the portion that we'll have to pay in the next year would go onto your current liabilities column. So I tried to combine that together. So you see on the left, we added up the assets. On the right is current liabilities and your net worth. So that at the bottom you see that they both balance. Cash flow statement is another document that lenders are going to be looking for, and it's important for you as far as managing your business. And it breaks down your income and expenses over a designated time. You could do that monthly or quarterly, at least yearly, so that you can project when you're going to need to borrow money or have some kind of an equity line of credit so that it will get you through the times before your income starts coming in. It tells you whether you can meet expenses, whether you can make your debt payment, and you can survive that transition period before your crop or livestock are harvested. We did a greenhouse cost accounting program that's online, and now I've added it, I've changed it so that it can apply to any enterprise, and that's one of the door prizes we're giving away today is a cost accounting program. We charge $150 for it, but there's a free version online if you're only doing 5 enterprises. So look on the farm management website for that. But we basically took the information you already have, your income statement, your balance sheet. I was asked to do a cost accounting talk years ago now, and I thought, you know, I can make this really complicated, but again, using the KISS principle, what do you already have? You have an income statement, and you have the information in your head for each enterprise that you have. And over the years, I've made it available to producers because it actually keeps getting more popular instead of less popular because people can do their own, but it's already tailored to agriculture. So the latest feature that we've added is this cash flow statement that takes the information from your income statement and goes across by month, so you can see where the income and expenses are going to come, and at the bottom see where the shortfalls will be. What does the cash flow statement tell you? Well, are you going to have enough money at the end of the month to pay all your obligations? And if not, where are you going for that money? So as I started mentioning the cost accounting program, the basic tools you need are that income statement or Schedule C or Schedule F, which is really just another way of doing an income statement, the production data for each crop or livestock enterprise, and either a spreadsheet or the cost accounting program that we have, and a desire to figure out which crops or livestock are making the most money. So here's the one that's online, that's free, and I don't know if you can see at the top. The website's sort of complicated, but if you go to Rutgers Farm Management, you'll get to all the things that we've talked about today, the later life farming, the greenhouse cost accounting, the videos from all the Annie's Project programs. So this is the input section. It basically follows the Schedule F. And I started out for greenhouse crops, but then I added outdoor crops. So it totals them up, and you have the total, and it calculates the percentage of sales for you. So it does a lot of math for you. Once you have it, then you can put the numbers in each year and compare year to year. And we added the balance sheet. Why? Because a lot of the financial ratios depend on your balance sheet to be able to calculate those ratios. So that was a section we added a few years ago. And we have a whole section that calculates your ratios. So what I did was take fact sheets from all over the country, from all the different land-grant universities, and looked at what they decided were the key ratios, because you can go through a lot of different ones. So if you see these ratios, these are just mathematical formulas taking information from your income statement and your balance sheet on your farm. And the spreadsheet is actually, because I'm an educator, I use this more as a teaching moment than anything else. So there's 17 ratios that my cost accounting program will calculate. And how did I come up with which 17? Because there's probably hundreds of them. I looked at fact sheets from all across the country and what ag economists thought were the most important ones for agriculture. Then in the second column, if you put in your information from your income statement and your balance sheet, which your accountant will give you. I've never been on a farm that didn't have an income statement and a balance sheet. So once you have those two documents, you can calculate any of these ratios. So the second column is your ratio, and then the third column is from all those fact sheets that I looked at from all over the country, what they said you should have on a farm. So that way you can compare your farm to what the recommendation is. And then the fourth column is the formula in words. For example, net profit margin is sales minus total cost, or net profit is sales minus total cost. And then on the last column is what does that mean in words? Okay, so I tried to make it all on one page, something simple that you can look at these financial documents, because I find for most farmers that's the most intimidating. We have some young farmers now that have come off from Wall Street, but mostly most farmers get into agriculture because they like farming, and this is the last thing they want to do is sit in front of a computer and do these calculations. So we tried, again, the KISS principle to make it easy for you to do that. But it's important if you want to stay in business. And I found over the years, and sadly I'm more popular than I used to be because your business is tougher to make money at. So I did those calculations for those example farms, and remember we said the profit margin was 9.5%, or the net income was about $200,000. Return on equity was about 28%. Return on assets 17%. But remember a few years ago when oil prices went way high, and this was for greenhouses, they have to heat, and actually the prices tripled in 1 year. So what happens to a business when the prices triple? So those red numbers are what happened. So we went from profit of 9.5% to minus 1.7%. And all of our other numbers are in the red. So I did some what if and said, well, what if I can just increase my prices by 5%? So look at the last column. We're not where we were before, but guess what? Nothing is red anymore. At least we're making $70,000 profit instead of losing. And our profit margin is 3%, which isn't 9.5%, but it's better than minus 2%. And our return on equity is positive, and our return on assets are positive. And I kept hearing greenhouses say, we can't raise our price. But guess what? If you can't raise your price, you're not going to be around very long. Luckily, the energy prices went back down. But this is the time that Arie Van Voot started raising his own fuel, and other people are looking at solar and other options. And the one good thing about doing this on the computer is you can do it on paper instead of in real life. So the other thing I thought, I looked at is, well, what if you could just cut your cost by 5%? So you have the column that I had before. So then the final column is, okay, if I decrease my cost by 5% instead of increasing the price by 5%, then my net income is still positive $75,000. So again, not $200,000 like it was before, but at least it's not in the red. So it's very similar. Either if I could increase my price or decrease my cost, and if I could do both at the same time, then I would probably be in pretty good shape. And remember, airlines added an energy surcharge, so you should be able to do the same. I took those numbers that I showed you for income statement and balance sheet, and I came up with a very simplified production schedule that would actually fit in a greenhouse of this size. And I had them growing these 5 crops: petunia flats, marigold flats, geraniums in 4-inch pots, and poinsettias in 6-inch pots. And I put how many units they started. And in a greenhouse, we do cost per square foot per week because it's a high intensive production. You could do the same thing per acre with other outdoor production. I look at the space each thing is taking up in the greenhouse, the weeks that it's there, and then the percent that I sold. If I go into the typical greenhouse, and in the past they grew the crops and then looked for a market. Now we're finding more and more contract growing where they sell it before they grow it, but the past was all you grow it and then you take a chance and find a buyer, and a lot of you do that. You take your produce to the farmer's market and you find a buyer. It isn't pre-sold. CSAs are pre-sold, but so I'd say, what percentage do you sell? And they would say, we sell everything. And then I would go to the back of the greenhouse and there would be a big compost pile of all the plants that they didn't sell. So you never sell everything. So that's an important, we call it a shrink factor, is what percent did you sell, and then the price that they were sold for. So I put in those numbers that I just showed you, and then those 5 crops. Well, if you look at sales, which one would you think we're making the most money if we're only looking at how much sales are we getting from this crop? So poinsettias, the sales are $653,000, and the other crops are less. But if you look at the profit per crop, it's petunias. right? It's $69,000. The profit per unit is petunias. But if we look at the profit per square foot, which is the only way we can compare apples to oranges, it's the geraniums in 4-inch pots at 21 cents. And if we look at the price per unit, it's $11.73. So if I could, in a perfect world, increase sales, which crop would I try to increase? The geraniums in 4-inch pots, because they're making me the most money, right? And a lot of people don't know. They know at the end of the year whether they're making money or not because the accountant gives them an income tax return, but they don't know which enterprise is making the most money. If we tripled the fuel prices, then you can see that we're losing money, mostly in the poinsettias, a little bit in the geranium flats. The profit or loss per square foot per week is only 3 cents. So if you could somehow reduce our cost, that 3 cents, we would be back in the black. So it helps in the wintertime when you have a downtime. This is the time when you do those what ifs and play with your formulas. So if we increased our price by 5%, then we're only losing a penny per square foot per week. So still not in the red, not in the black, but not too far off. And if we start playing with this even more, a lot of people in the past would say, well, if poinsettias are losing money, just don't grow poinsettias. But what happens if I took poinsettias out of this picture? You'd lose that part of the season. You'd probably have to lay off people. You may lose customers. But guess what? They're contributing to overhead cost, and then everything else starts losing money. So unless you can reduce costs enough to make up for the income that you're getting from those poinsettias, you almost have to treat them like a lost leader and still keep growing them until you can find some alternative. Now remember I talked about the shrink that people say they sell everything, and I put in a 95%, but if I change that to 80%, look what happens. It has a bigger impact than that fuel. The fact that I'm putting all that cost into growing things that I'm not selling. So then you have to decide, should I cut back production? Should I cut my price? And those are difficult decisions because if you start cutting your price, what happens? People wait till you have the sale and nobody buys it at the full price. So there's a lot of tough decisions that you have to make as a manager of your operation. So here's what happens to some of the profit, the ratios that we talked about, your net income, your profit margin, and so forth. Almost all of them go red if you can't sell. And again, we added these outdoor production because we found that most people who had greenhouses were growing outdoors. So you can go through a similar operation on that outdoor production part. I guess we're doing it on a per square foot, but you could just call that acres and do the same thing for other crops. We have the cash flow statement then that goes along with this cost accounting program for each month. And you see, it's hard to see here, but it'll show you which months you're going to have to borrow money to get through the year. And why don't you calculate your own cost? Well, because in terms of greenhouses, they're not plants people, and they'd rather grow plants than calculate their cost. They're afraid of the unknown. They don't want to know that their favorite enterprise isn't making money, or it takes a lot of time, which it does, or they're happy with the status quo, but the status quo isn't cutting it anymore. So it's really important that you do your own cost. So when you do them, some tips: be realistic about your budgets. And I know that farmers are very optimistic. Usually nobody calls me until they're really in trouble, unfortunately. And then when I go out to help them, guess what? Even though they lost money this year, next year they're going to get twice as much income and their costs are going to be half. And that usually doesn't happen. So you need to be realistic. If you're starting a new enterprise, you're probably not going to make money the first year. It's going to take a while. So make sure that your yields and your prices are realistic, and you get some help from USDA, from FSA, from County Extension Office. In terms of creating a new enterprise or building something new, what about the capital requirements? How much money do you need? What's the purpose of the funds? Is it for equipment, labor, land? What are the terms and the rates? And can you afford the debt schedule? So how often should you review your financial records? Well, definitely at least once a year, but probably quarterly, because if you wait till the end of the year, it might be too late to do something. And the bottom line is you need to calculate your costs because everybody's costs are different. So here's the resources. The ag plan. We have a So we have a market-to-market workbook online that's at the Rutgers Farm Management website. That's where you'll find the interactive crop budgets. If you just put this much in, you can go scroll down the left-hand column and find that the crop budgets. And the cost accounting program on Excel, you can email me and order it from me